The very nature of stocks that create the biggest wealth is that they are the rarest of the rare. If you do not believe me, consider this statistic shared by Gautam Bed, author of Joys of Compounding and earlier a guest on Equitymaster's Investor Hour. Between 1926 and 2018 in the US stock market, only 4% of all listed equities accounted for 100% of the wealth creation. You heard that right. In as many as 92 years, only 4% of all listed equities in the US accounted for all the wealth created there. Now, since we are referring to the American stock markets, we cannot blame the underperformance of 96% stocks on the lack of maturity of the markets. Now, can we attribute any economic or geopolitical risk as the cause? This is because the performance has been gauged over nearly a century. Does this apply to Indian stock markets too? It certainly does. Simple as it may sound, selecting the 4% of the listed stocks and holding on to them for decades requires skill, determination, patience and grit. Unfortunately, most investors who enthusiastically start out in the stock markets withdraw or get dismissed too soon. Few others manage to go some way, but their stocks keep failing in wealth creation. Just a handful of investors manage to get to the finish line of their long investing horizon to see the stocks compound into true wealth. My favorite advice here is to finish first, you must first finish. In fact, I often cite the similarity between the marble and spoon race and the stock markets. In the marble and spoon race, most participants underestimate the importance of posture, concentration and goal setting. As a result, barely anyone reaches the finish line. The usual traits of speed, strength and agility necessary in other races do not serve well here. Turns out the biggest wealth creators in the stock markets are businesses that have thrived for decades. So it's not surprising that in the US, they were just 4% of all listed businesses over a century. Investing in them requires the skill that does not apply to 96% of the other listed stocks. The other 96% stocks may comprise of blue chips and mid caps of ordinary quality, or small caps and penny stocks offering temporary value upside. Now, there is a good chance that some of these stocks fetch decent returns over few months to few years. So, I am not ruling out buying few small caps and penny stocks after necessary due diligence and with some safety parameters and valuations. By all means, these stocks comprising 96% of the market, when selected diligently, may be good for near to medium term gains. If you are lucky, a few may even turn out to be multi-baggers. But given the low allocation to such stocks, they are unlikely to move the needle of gains in your portfolio. But focusing your time and energy to pick the venerable 4% stocks and holding them for the longest investing tenure will make a difference. Paying any attention to the chaos around or turning to see other participants can be the biggest risk in the marble and spoon race. Similarly, too much focus on other investors or volatility in the market can never be the recipe for stock market fortune. Now, if you are worried of an impending market crash hurting your dreams of creating stock market fortunes, you are not alone. What if I tell you that the 4% strategy is not only perfectly positioned to survive a market crash, but it also stands to gain immensely from the market crash? In the stock markets, the fortune of the benchmark indices has come to rest on few star performers over the years. The bulk of the investor money comes to them, and investors firmly believe that only those stocks could create wealth over the long term. But the fact is that the performance of index stocks will at best trail the index over the long term. So if you're looking to make big gains in blue chips over the next decade, then you need to look beyond the Sensex stocks. You see, a lot of the quality blue chips are not just restricted to the Sensex alone. If you widen your horizon a bit and look at, say, the BSE 200 index, then there are quite a few blue chip stocks that are set to deliver handsome gains over the long term. The easiest way to track what could help stocks have a long runway of superlative returns is to find qualities that can help them overcome every crisis. For instance, capital efficiency. The companies that prioritize reinvesting profits to earn higher returns on their shareholders' equity rarely go wrong in capital allocation. Such companies are careful with their capex and acquisitions. Plus, surplus cash is often distributed to the shareholders. The idea is that more profitable the company gets, the more the value it will create. Second, low leverage. Minimal debt, which is a debt to equity ratio, is extremely important for companies to tide over periods of tight liquidity and high interest rates. Profitability with low capex. Companies that have already done the hard work of building plant and machinery or network for future growth are typically in a ripe phase to benefit from the efforts. Scope for PE expansion. Ironic as it may sound, even some of the most solid businesses with reasonably high PE multiples tend to have a huge room for PE expansion over the very long term if the business and management went in the right direction. If I must pick just one characteristic that has been the key catalyst of several decadal multi-bagger stocks in India, like Asian Paints and Titan, it would be their PE expansion. Larger the PE expansion, higher has been the quantum of returns for the top multi-baggers. Last but not the least, technology catalyst. Technology has the power to change lives over time. Imagine a world in the future where an autonomous vehicle picks you up from work, it plays your favorite playlist, and it makes a quick stop for your morning coffee. All this without you having to touch your wallet or your phone. This is how the devices enabled with Internet of Things could transform our everyday lives. The reason this technology is so important is because it could transform the future growth rates of multiple businesses. When I say that, I mean businesses as diverse as healthcare, automobiles, financial services, retail, agriculture. Now, as an investor looking for exponential profits over the next few decades, you cannot just look for the tried and tested businesses or the most popular brands. Rather, you need to look at stocks where the technology is acting as a huge catalyst of change that could offer exponential earnings growth in the years to come. Now, even in India, just 4% of the listed stocks can be true game changers for an investor's portfolio. Having the patience, perseverance, and discipline to find and hold on to them can offer the compounding effect that 96% of the stocks can't. So, why buy 96% of the stocks when just 4% can help create wealth? Stay tuned to understand how to identify the rare 4% listed stocks. Hope you like this video. Thanks for watching.